Hey guys, welcome back to the channel. Today's show is about stock investing. I'm excited, as this is an important theme, and I want to highlight it. Stocks are not lottery tickets. I know in today's market that's tough to understand. But there's a company behind every stock, and a reason these companies and their stocks perform the way they do. Years ago, in Peter Lynch's book Beating the Street, he talked about the golden rules. This video is an updated view of the 25 golden rules. Let's get after it. The 25 golden rules. Some are timeless, and others need updating. Here we go. 1. Investing is fun, exciting, and dangerous if you don't do any work. This is timeless. Do the work and research about the companies you're investing in. Investing isn't gambling. 2. Your edge as an investor isn't something you get from Wall Street experts. It's something you already have. You can outperform the experts if you use your edge by investing in companies or industries you already understand. For example, if you are in the technology industry, investing in tech companies that you know. You can see the industry landscape better, since this is your area of expertise. Your edge is you know good versus bad operators, or who is going to have strong earnings long term. Press your edge. Don't be a follower. 3. The stock market is dominated by a herd of professional investors. Contrary to popular belief, this makes it easier for the amateur investor. You can beat the market by ignoring the herd. Professional investors have to follow the market to beat benchmarks and meet short-term expectations. You can invest differently since you can ignore the herd. 4. Again, behind every stock there is a company. Find out what the company is doing, and understand it well, before investing. Again, if you are in an area you understand better than some Wall Street or hedge fund analyst, you have an advantage. 5. Often, there is no correlation between the success of a company's operations and success of its stock in the short term. However, in the long term, there is a 100% correlation between the success of a company and success of its stock. This is the key to making money. It pays to be patient, and to own strong companies. You can buy strong companies when the price is short-term impaired or down, due to short-term issues. This is how you capture the value between the market and the actual value. 6. Know what you own, and why you own it. The gambling environment of today doesn't count. Buying bad companies to squeeze short sellers isn't a strategy that is in the 25 golden rules. 7. Long shots almost always miss the mark. Again, this isn't gambling. The last horse rarely has a comeback from last to first. We hear about long shots succeeding way more often than they actually occur. A company that is a poor company, with a great idea or product, is still a poor company. While technology can close the gap, it doesn't solve for bad management, bad leadership, or bad direction. So even if the long shot has the stock turnaround, their day in the sun will be limited, if it is a poor company. Now, almost any industry can be disrupted and industry leaders change quicker, so long shots will likely be short-lived and not meet the mark. 8. Owning stocks is like having children. Don't get involved with more than you can handle. The part-time stock picker probably has capacity and time to follow 8 to 12 companies with great detail. There don't have to be more than 5 to 7 individual stocks in your portfolio at any one time. Trying to follow or track more companies may seem easier with technology today. But how deep is your knowledge about the 15th or 20th stock on your list? Keep it manageable. 9. If you can't find any companies that you think are attractive, put your money in the bank until you find some. There is nothing wrong with keeping dry powder and waiting for the right time. Patience is a virtue. 10. Never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. Always look at the balance sheet to see if a company is solvent before you risk your money on it. Lately, some poor companies have been bailed out from all the speculation and gains in their stock price, so they have been able to restructure some debt. However, these are still poor companies. 11. Avoid hot stocks in hot industries. Great companies in cold and boring industries, like non-growth industries, are consistent big winners, and aren't over-dependent on the market multiple. Those companies that are creating tangible book value and consistent returns. This approach won't have you investing in the flashy names, but will also avoid losses on high-profile failures. 12. With small companies, you're better off waiting until they turn a profit before you invest. Every new company wants to be like Amazon, with a long window to turn a profit. But shareholders require profits on their investments. And back to the previous rules, what if profits never come? Is it a good company? What is a zero-profit company worth? 13. If you are thinking about investing in a troubled industry, buy the companies with staying power. Also, wait for the industry to show signs of revival. Buggy whips and radio tubes were troubled industries that never came back. This is even more powerful advice today than prior decades, as disruption is everywhere and technology advancements seem to be occurring more frequent. 14. If you invest $1,000 in a stock, all you can lose is $1,000, but you stand to gain $10,000 or even $50,000 over time if you are patient. The average person can concentrate on a few good companies, while the fund manager is forced to diversify and make other decisions due to their role. By owning too many stocks, you lose this advantage of concentration. It only takes a handful of big winners to make a lifetime of investing worthwhile. 15. In every industry, in every region, or every country, the observant amateur can find great growth companies long before the professional investors have discovered them. A small company won't hit a professional's radar as quickly. You can see them as a consumer or if the company is local to your market. This gives you an advantage. 16. A stock market decline is as routine as a winter blizzard in Colorado. If you're prepared, it can't hurt you. A decline is a great opportunity to pick up the bargains left behind by investors who are fleeing the storm in a panic. Again, preparation and keeping dry powder is the advantage of the small investor. 17. Everyone has the brain power to make money in stocks. But not everyone has the stomach. If you are susceptible to selling everything in a panic, you ought to avoid stocks and stock mutual funds altogether. If you panic or follow the herd mentality, the sharks in the market will destroy you. 18. There is always something to worry about. Avoid the dire predictions of the news. You sell stocks because the company's fundamentals deteriorate, not because the sky is falling. This is timeless and even more important with the 24-hour news cycle. 19. No one can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what is actually happening with the companies that you are invested. Accountability for predictions and opinions is at an all-time low. There are plenty of opinions, with no skin in the game for outcomes or being wrong. Focus on your own investments, since you have skin in the game. 20. If you study 10 companies, you will likely find one which the story is better than expected. If you study 50, you'll likely find 5. There are always pleasant surprises to be found in the stock market, and there are companies whose achievements are being overlooked by Wall Street. This is a numbers game, find your companies that are overlooked. 21. If you don't study any companies, you'll have the same success buying stocks as you do in a poker game bet without looking at your cards. Again, this isn't gambling. You need to do the work and research, it's not writing a hot craps table or other gambling. Learn and put in the time to get better at analyzing the companies you're considering. 22. Time is on your side when you own shares of superior companies. You can afford to be patient, even if you miss the first 5 years of a great company. If it still is a great company, it will be a great company for the next 5 years. Keep in mind, time is against you when you own other products like options. 23. If you have the stomach for stocks, but neither the time nor the inclination to do the homework, investing in mutual funds is the way to go. It is better to diversify if you don't know what you're doing. You should own a few different kinds of funds, with managers who pursue different styles of investing. Examples are funds in growth, value, or small companies, large companies. Transactional costs and taxes penalize investors from switching from one fund to the next. If you've invested in one fund or several that have done well, don't abandon them carelessly, stick with it. 24. You can take advantage of the faster-growing economies by also investing some portion of your assets in an overseas fund with a good record. This will bring growth potential and diversity. 25. In the long run, a portfolio of well-chosen stocks and/or equity mutual funds will always outperform a portfolio of bonds or money market accounts. Many of these golden rules stand the test of time for a small investor beating the street. There is plenty of opportunity for small investors to not take undue risk and use stocks to their financial advantage. A stock portfolio is key to financial freedom, if done right. Try to circle back to these 25 golden rules regularly, to see if you are on the right path. Thanks for watching. Please like and subscribe to the channel for more financial freedom information.